Adam, some of the observations you made there, I'm keen to explore how they affect your fund selection process. So the new breed of family and private investment office, your group typically chooses some more off the beaten track managers to run clients' funds rather than the usual Fidelities or Franklin Templetons. Do quant funds ever get a look in, or do you feel they're a peculiarly institutional tool and that private investors will only really buy into those investment themes they can understand, like the .com TNT theme you mentioned earlier on, SRI, private equity or geographical sectors, rather than a systematic black box style strategy?
A lot of it goes back to the question of time frames and in what period you expect things to come right. And of course that involves a judgment about the tolerance of the family or the client that you have. How long will they wait for everything to come right? Secondly, a question of how do you define quant? In our approach, we take a long-term view for people with a long-term view in evaluating what kind of strategic asset allocation they should have, and then make moderate tactical adjustments. And trying to find managers who are differentiated in style. And if you choose a number of managers, clearly you can take managers who have a higher degree of risk in their portfolios because you have the diversification amongst managers. Personally, I'm something of a skeptic about depending too much on quantitative theories in the short term. If you find clever hedge fund managers who can do that, then you give them some of your money but not all of your money. To bet too much on any quantitative approach I think has risk to it, and the extreme example of that perhaps is LTCM, long-term capital management, which as we all knew blew up. And my overall sense of quantitative theory is that if everyone believes in a particular thing being true, by definition it won't be. It's like everyone saying, is it safe to go skating on the ice? How many people fell through in the last 100 years? Answer 3, okay, let's all go on this afternoon, and the ice cracks, and even those who are playing it safe and close to the shore go down with it. So that's my philosophy.
So I'm correct in assuming that where we're talking about man versus machine, about insight, creativity and investment as an art rather than a science, you will always prefer the artist for your office, the highly skilled active investor, rather than the rigid discipline and computer-led models of quant investing.
Yes, but I'd have a quantity of them. In other words, I wouldn't put all my faith in one. But I think what Professor Rajan was saying rang very true. It's a balance. But of the two, the more important is judgment.
Mm-hmm. Very interesting. Could I
just add something very quickly to that? I think when we talk about a particular strategy like quant strategy, we also need to really distinguish between different client segments. Yes. And particularly when you look at institutional clients, the latest data that we've got shows very clearly that they are really segmenting their portfolios in ways which really is very interesting and novel. Could work, may not work, time will tell. But basically what they're really doing is creating a number of buckets, and quant sits in one of the 5 buckets. The first bucket is, they're hedging out as many risks as possible, risks for which they're not rewarded. So they're taking off interest rate risk, inflation risk, mortality risk off the table. Second, something like 50%. And it really, in some institutional clients' case, it goes up to 70%. But up to somewhere between 50 to 70% of assets are now being put in what they call exotic beta. These are quant funds with different sector orientation or country orientation or strategy orientation and so on. So that's the biggest bucket. The second bucket is buy and hold bucket. And this buy and hold bucket only has about 20% of assets, right? And a lot of quant strategies sit in that buy and hold bucket. This is a bucket where people are taking long views along the lines of what Adam was saying and what Professor was saying. You look at the fundamentals and you have a deep conviction that this strategy is going to work, and all you've got to do is to ride out the short-term considerations. However, long-term buy and hold is only about 20%, and I'll come to the reason for that in a minute very quickly. But let me talk about the other 2 buckets. The third bucket is the absolute returns bucket. That's about 10%. And then there is the opportunistic bucket, where it's about capitalizing on distressed assets in debt markets or private equity, secondary markets, and so on. So they're really adopting this bucket approach in order to target different kinds of risks. Now, when it comes to long-term buy and hold, the percentage is so small, 20% as I said. That's largely partly because of the mark-to-market rules, because they say, okay, it's great to be a long-term investor, but if short-term is screwed up, you're screwed up as well. Well, that's what mark-to-market rules mean. The other thing is really that they are very disenchanted with active management over the last 15 years. And trustees are increasingly sort of saying, you know, that we don't want, if you really want to invest in equities, go into beta products rather than alpha products. So there is this bucketed approach, and I think we have to look at each strategy in terms of which particular bucket they sit in, and you know what the risk appetites of individual clients are. So I can see quants being very important, but you know the old style quants are not really taken so seriously. New style quants is something very similar to what James was implying, that you know you look at the data, yes, you create models, but you know you use them as a kind of a verification tool, rather than something on which you bet your shirt. You don't do that anymore. You combine it with judgment. And I think judgment, instinct, insight, whatever you want to call it, those things are becoming very important in long-term buy and hold investing.
I mean, can I ask you a question? Go back to John's point on multi-beta and multi-risk modelling, and therefore the chiming in of what is exotic beta. And one of the trends that I would observe is a hard realisation that a lot of people have been charging for alpha but delivering beta. And how much of this move that you observe in funds is because people think, actually, I've been paying the wrong price for the wrong product?
Very much so. And the three of the biggest pension plans who participated in our latest research, three of them found that when they did their long-term analysis of returns, the biggest source of outperformance was fees on a compound basis. So they're basically sort of saying, if you can get a cheap product, you know, and something which also makes sense in terms of some of the fundamentals or some of the beliefs that you have about the long term, that's the way to go. You know, rather than going for super duper absolute return funds. And it's very interesting that if you look at the last decade, that absolute return bucket was about 24%. In this decade, according to our latest numbers, it's going to be only about 10%. Because people are saying, absolute return funds are great, but remember that the managers, if absolute return space is a high dispersion space, you're going to get a few people, few rocket scientists delivering outstanding returns, but you know, about 97% of them, according to our results, are at best going to give you leverage beta. And many will give you even less than beta net of fees. So that kind of thinking is percolating. And I think, if you know, I was very interested in your idea, Professor, about markets sort of learning from itself. I think investors are learning a lot on the basis of two big 4 standard deviation events that we had in the last decade. There's a huge degree of introspection that's going on.